Hello everyone, and thanks for joining us on the latest edition of the JIC Research Edge. My name is John McEvoy, a portfolio manager here at Johnson Investment Counsel, and joining me today is Aaron Taylor, a research analyst that covers the market's energy sector. Aaron, it's early June and millions of Americans are considering a summer road trip. Fuel and transportation costs are a big part of that consideration. Can you tell us a little bit why gas prices have been rising recently?
Sure. As you alluded to, John, gasoline prices have risen sharply. We're up over 25% from a year ago levels. Gasoline prices at the pump are approaching $3 a gallon. That's been driven by strong demand and higher oil prices. And the key demand driver there has been synchronized global growth. But within that, the U.S. has seen a recent pickup from the tax cuts that happened earlier this year. And we saw record demand levels for gasoline in the months of March and April, as measured by the U.S. Energy Information Administration.
Aaron, we've seen gas prices rise considerably over the beginning part of the year. Is this a trend that you see continuing over the rest of the year?
Well, gas price trends have a lot of moving parts, John, such as the economic backdrop that we're in, refining output supply, OPEC decisions on what they're going to do with crude oil production, be it increase it, decrease it, or maintain their current levels. And then also we have to deal with the unpredictable hurricane season. Based on where we are now, I would say that we've seen the majority of the upward price swing in gasoline prices, and that's based on historically prices top out around the months of June or July. And that's as refining plants finish what's called the turnaround season, and that's where they switch from their winter blends over to their summer blends.
Aaron, that leads us to the question, what impact do you think rising gas prices will have on the equity market, and particularly the energy sector?
Well, as for the overall equity market, I don't believe prices are high enough to be cause for concern just yet. I think we need to push $4 a gallon for it to be problematic for the equity markets and for the overall economy. And turning to the energy sector, gasoline is not really a big needle mover. That's more about oil prices. And for oil prices, we see those in a price range. And I'll give you 3 key reasons why. First, we have Saudi Arabia and Russia that have hinted at increasing production, offsetting some supply shortages from other OPEC nations. Secondly, we get clarity on some political unknowns, such as what the U.S. is going to do with the Iran nuclear agreement and what the sanctions are going to be against that country. So that provides less geopolitical risk and that provides price clarity. And then finally, our own economic strategist, Brandon Zurich, believes that we see some emerging market growth slowdown, and that will imply less robust oil demand growth from those countries.
Thanks for taking your time to answer our questions. That was very helpful. We appreciate you watching at home. If you have any investment questions, please contact your team here at Johnson Investment Counsel. Have a great summer.